I was hoping stocks would be able to take good news in stride, but they just couldn't quite do it. Equities faded and looked kind of listless in the second couple hours of the day. Even though there was a bump in the late morning, markets gave it back and we ended near the lows. The light's been yellow for stocks because we've been range bound, but today looks like we did not just edge to the low end of that range like we were earlier this week, but actually started breaking it and started eating into the election pop. And so for that reason, just going from the technicals of lower highs and lower lows, the red light's got to go on stocks. With the caveat being that I think you still are basically in a range of support, in a realm of support technically, so it doesn't have to break down fast, but it's hard to ignore the momentum rollover here, especially when there's two main factors that just are not good. One is that interpreting good news as bad is just terrible. Even though we've done that many times over the last few years, it can become a pretty vicious cycle, and it tells us that the market's out of whack when you're selling off on overall solid data. But the catch this morning and today was that some of the data wasn't just good, it was also kind of bad in the inflation implications, given the sentiment number showed inflation expectations rising. That's a self-fulfilling cycle that can keep prices high. When you combine that with the bubbly nature of valuations over the last couple months, they were expecting a really rosy outlook for policy. Some of this stuff is just looking like it's too much to bear for stocks right now. So, number one, here's the chart. Just the technicals. Forget the fundamental stuff and the policy ideas. I'll get to that in a second. Just from the technical standpoint, you got lower lows here. Today's intraday candle traded at the lowest that we've had this year, which continued the downside, which also had lower highs after a range. I mean, this is pretty clear technical stuff. You had a range. It broke. Then you had a new one established, and then it broke again after multiple attempts of support right at the election gap. Now, this is when you start to then talk about the fundamentals, and this is where price overlaps with the narrative. That's what makes markets beautiful. As we eat into the election gap, we're also eating into the election narrative. We got some really bubblicious valuations, the highest since COVID, which were the highest since .com, on the expectation that we were somehow not just going to have a soft landing, which we have been getting, by the way. This is the soft landing, but we were pricing in something a little bit more immaculate and probably impossible, which was that there's going to be more growth coming from the new administration, and it's somehow going to happen without inflation. It's going to somehow happen with lower yields and lower dollar. This stuff hasn't made sense, and it's really what I've been pounding the table on. That's what's been told by the dollar chart and the yields, and that's why I kept the green light on stocks for a while and then the yellow light, even though yields were blowing out and the dollar was blowing out, because it's still overall a good situation for the economy. And by the way, technically, there very well could be some support here in the 58. But the idea is that the rollovers now happen, and there's a lot of logical gaps in the narrative for stocks. Look at the chart for bonds and yields. When you've got this big move that we've been getting to the steepening, it's been a good thing. But it's kind of looking more and more like it may be turning south. Today, you had some really important action, which was this big red candle in the 10s to the 2s. All of this steepening was generally a good thing, because it tells us that you're repricing bonds based on better than expected economic data. But today was really important because when the inflation expectations on sentiment hit, the 10 to 2s then contracted because the 2-year was coming up. So the market's saying not only that the Fed is done cutting, but there's a scenario here, if we pile on more policy, that the Fed might actually have to go and hike. And that, of course, is totally opposite to what many folks were expecting in terms of the actual playbook for this year. Not only were they wrong on low dollar, low yields, now they might be wrong that the Fed is not just not cutting, but might actually have to go to hikes. I still think that's way out in the future, but the point is the trade-off right now is not great. You see this in the regional bank sell-off today. Here's the KRE in the blue line. This was a pretty big breakdown on the chart at the same time that the 2-year yield is breaking out. It's one thing to have the 10-year yield going up. It's another to have the 2-year going alongside it. That's telling us we're getting to a point where the good data might be a little bit too much to handle, and the stocks are just too expensive to deal with it.